Hello friends, how are you doing out there? This is Vijay Bhambwani here and I'm back with you in my weekly market outlook video. What a week it was. We basically went into blue sky territory when the bulls at no matter what price they've bought Nifty futures are in the money now. And there is no overhead supply coming in from people who are trapped at higher levels and they're waiting to exit, which means that the possibility of the market rising further cannot be ruled out. Do you remember the thumbnail that I had made for my video last week? Retail power prevails. Yeah, that's right. So the retail guys did manage to, in spite of their profit taking, which was mild and muted, but they pushed up the markets to new highs. So let's take a deep dive and see what's happening in the week ahead. And I'll share with you some exclusive in-house studies that you won't find elsewhere and help you make informed decisions. So as you can see the weekly market roundup window on your screen, the markets continued with their upward march, which I had advocated through the impetus data, which of course is a very powerful tool that we've developed for our statistical model, the Barracuda. And the retail segment does continue to remain in command right now, and they pushed the Nifty, which is a broader based index as compared to the Bank Nifty, relatively higher than the Bank Nifty itself. All right. It's not that the Bank Nifty didn't rise, as you can see on your screen, but it's just that the Nifty 50 happened to outpace it. Now, are we surprised about this? No, you shouldn't be, because by now I've explained to you many times in my weekly videos as to how the 10-year benchmark bond yields speak louder than words and impact the banking stocks as well as the Bank Nifty significantly. Now, the 10-year benchmark bond yield, as you can see on your screen, remained above the 6.20 levels for 4 days in a row. Bullion and energy witnessed profit taking from higher levels. Gold actually saved the day, but silver succumbed to profit taking. Oil and particularly gas fell, and that's good for equity markets because inflationary concerns will kind of ease, and paper assets are likely to see a little more buoyancy or bullishness. Now, the USD INR gained, which shows that the rupee weakened against the dollar, but very mildly. It was actually the Dixie that kind of fell significantly on Friday, and we're going to cover that when we come to the Dixie itself. The MWPL, the market-wide position limits, which shows the risk appetite of traders who are willing to roll over their positions, their exposure from one day to the next. The MWPL chart on your screen shows a spectacular rally, something that I hinted at last week also. Now, the peak open interest, as you can see in that chart, is higher than where the July series ever reached, which means that the open interest of traders is now at its highest in June, July, and August segment. This shows that traders are willing to bet on higher levels in the markets. Now let's take a look at the volumes chart on your screen. It shows cumulative figures for August, September, and October futures. Turnover has improved on a week-on-week basis, though fairly mildly, but on Friday, there was a noticeable rise in traded turnover, which is positive. Now, we must watch the price and volume correlation in the coming days also. Ideally, if the markets are headed higher, volumes must also rise. Now coming up on your screen is the basis chart. Now see how the basis, which is nothing but the premium enjoyed by the futures vis-a-vis the spot market. The basis chart shows premium falling, and that was triggered by selling at higher levels. And not just selling from short sellers. This selling also comes from guys who have delivery-based long positions or even long positions in the futures in individual stocks, but they are hedging by selling the index futures. So it's not all that bad. And the basis actually contracted. Nifty actually went into inversion. By inversion, it means the future price is actually trading at levels lower than the spot price. Keep watching this development, which I update on my social media account late every evening. And if you connect with me on social media, my contact coordinates will follow at the end of the video. I will update this data in real time every day. End of the day every day, I'm sorry. So another of our exclusive studies coming up on your screen, which is an in-house study you won't find elsewhere. Last week, it told us that the markets wanted to go higher. I am talking about the impetus. Now, this week, I see the impetus tapering off in both the indices. Does that mean that the markets are going to fall or even crash? No, I'm not saying that. Remember, the impetus still is positive. It's just that it is easing. That means the acceleration or the velocity seems slower. Now, of course, Friday was a big gain day for Nifty, and to an extent even the Bank Nifty recovered. But we need the impetus to pick up along with the price for a sustained up move. Now, let's see another one of our studies, which is one of the most popular, where we see the footprint or the exposure and commitment levels of 4 types of market players. Let's begin with the FIIs. They raised their longs last week, and their index longs were raised to 65,572 lots from the previous week of 58,635 lots. Stock longs went up to 1,17,156 lots, which was 77,595 lots last week. The DIIs, or the domestic investment institutions, cut their stock shorts, which is in a way telling you that they're not all that bearish. You can't say they're bullish, but they're not as bearish. So the DIIs cut their stock shorts to 11,90,818 lots, which was earlier 11,98,262 lots. And they cut their index shorts to 59,619 lots, which was earlier 62,262 lots. Proprietary traders, now these are Sharpies. These guys know what's happening in the market because they are brokers, they are empaneled with mutual funds, FIIs, etc. So they know who's buying and who's selling. Now, these smart cats have cut their stock futures longs to 1,75,103 lots, which was earlier 1,86,739 lots. This is a very small red flag, but you combine it with the impetus and it's noticeable. You can keep that in mind, but right now there is nothing to panic about because things can change on a day-to-day or even an hour-to-hour basis. Now, let's see the retail guys. They deserve our special attention because so far they've been powering the markets higher. And what are the retail guys doing? They've been booking profits. Now that's something that many old timers did not expect retail traders to do. It was believed that the newbies only knew how to buy, but they didn't know when to get out. But hey, look at the chart. They've cut their stock longs to 8,98,599 lots, which was earlier 9,33,928 lots. And their index longs are concerned, they've booked profits and brought them down to 17,639 lots long from an earlier 19,940 lots long. Friends, let's now go to the 10-year benchmark bond yields. This is one of the most important segments of the market, and this is a source of all funds. Let no one else tell you that bond yields don't matter to equities, especially banking stocks and the Bank Nifty. That's an incorrect notion. And since this is the money source, you need to know what the money is doing. And here, the bond yield, the India 10-year benchmark bond yield, stuck to the upper end of the 3-month range at 6.23% for 4 days in a row, just like it was magic glue, the Fevikwik. Now, there's an increased likelihood of rising interest rates in the medium term, let's say 6 to 9 months from now, because the big money will not write big checks at these low rates of yields when inflation is actually rising. The ultra high net worth individuals and the high net worth individuals are people responsible for moving the needles and gauges of the markets, and they are resisting deploying money at falling interest rates. Like I said last week, don't buy any electronic goods on EMIs or even property. If at all you want to buy it, don't buy it at floating interest rate loans, because whenever the rate goes up, your EMIs will start to go up. Don't trade bank stocks and the bank nifty unless you've checked the 10-year benchmark bond yields carefully. For now, the equity markets are exuberant, they are happy, so the going is good. Now, those of you who are on my free WhatsApp broadcast list, you would have got an update on Friday morning about bond yields and their impact on banking stocks and bank nifty over the next 6 to 9 months time frame. If you're still not on that list, just email me your cell number and we'll get back to you and put you up to speed. My contact coordinates will come at the end of this this video. So do stay with me till the end. Friends, let's now go to the Dixie, the US dollar index, the US currency benchmark, which fell mildly on a week-on-week basis, even though it rose on 3 out of 5 trading sessions. The daily chart on your screen shows why. The steep fall on Friday was the single largest factor for this decline. And the price remained above the 25-day exponential moving average, but it just managed to stay above this. The outlook is guarded in the absolute near term. Now let's take a look at the weekly chart. The last candle in this chart is a sort of inverted hammer, which shows bulls were on the back foot towards the week's end. The price remains above its 25-week exponential moving average, which means the medium-term outlook is positive, but for now. And the support and resistance levels remain constant, where I have been telling you since weeks. 91.5 on the downside and 93.5 on the upside is a band. Last week, I advocated a range between 93.85 on the upside and 91.75 on the downside, which held perfectly well. The coming week may see estimated range. I stress upon the word estimated, between 93.50 on the upside and 91.55 on the downside. Now keep watching this index no matter what anyone tells you. Everything from inflation, oil prices, bullion, bond yields, and even equity prices and sentiments depend on this single factor. Friends, let's now go to the Bank Nifty, which rose 1.01% in the week. It rose on 4 out of 5 trading sessions, and this index stayed above its 25-day exponential moving average, which shows on your daily chart on your screen, which means the short-term outlook is positive as well. Last week, I mentioned that the possibility of an all-time high was open provided the bulls triggered a breakout above the previous swing high and did not allow the index to fall below 36,500 levels approximately after the breakout. Now we are slowly getting there. Once we cross over the 36,500, we would have basically a better fighting chance for a new high coming, provided it doesn't fall back below this, of course. So the coming week or two maybe are mission critical for the Bank Nifty bulls. Note the broadening price pattern. It indicates larger price moves, which means higher volatility, which means traders will need a lot more conviction in their trades to make money from the market in the Bank Nifty. Now let's move, my friends, to the weekly chart, where the last candle is smaller, that which is confirmed by the falling impetus, remember, which I showed you earlier. Now, these studies are exclusive to us and are nowhere available in the public domain. which adds to our confidence in our prognosis of the market. And the price remains above its 25-week exponential moving average, which means the medium-term outlook is positive also. Bulls must keep pushing prices higher or they will risk running out of momentum. Last week, this index was number 3 on the most volatile list, but it fell one notch to number 4, which is again a kind of confirmation of the slowing impetus. Last week, I advocated a range between 37,200 on the upside and 34,400 on the downside, which held perfectly well. The coming week is likely to see an estimated, I repeat the word estimated, range between 37,500 on the upside and 34,825 on the downside. Friends, I think you should continue to trade light because volatility may be a little high. Let's now come to the Nifty 50, which rose 1.79%. And the first thing that comes to my mind are the words up, up, and away. Note how the index has peeled away from the channel, which saw sideways consolidation and is trading above its 25-day exponential moving average, which means even the short-term outlook is positive. And as long as this situation continues, the price remaining above the 25-day exponential moving average, the bias is on the upside. The index, like I mentioned in the beginning of this video itself, is in blue sky territory. No overhead supply is expected. Let's now take a look at the weekly chart, and this index along with the Bank Nifty also shows a smaller candle. Do remember that the impetus has fallen, which means intraday ranges also have contracted. The price remains above its 25-week exponential moving average, which means the medium-term outlook remains positive. Now, in the week before last, this index was at number 7 on the most volatile list, where it remains as a constant. Last week, I advocated a range between 16,675 on the upside and 15,825 on the downside, which held perfectly well. The coming week is likely to see an estimated, I repeat the word estimated here, range between 16,950 on the upside and 16,100 on the downside. Here again, let's trade light because of the higher volatility. Friends, the indices done. I now come to the most popular segment of this video, wherein I'm going to recommend 5 high beta, high impetus stocks where you will take small exposure, wait for big price moves. It's a knife that will cut you both ways. And the other is low beta, low impetus stocks where you take big exposure, wait for small price moves. Different traders, different mindsets, therefore different techniques. So the high beta, high impetus stock list is led by Manappuram Finance at number 1, number 2, Aurobindo Pharma, number 3, Lupin, wow, another pharma, number 4, Cadila, number 5, Torrent Pharma. A lot of pharmas there. Apart from Manappuram, all the remaining 4 are into pharma. Now the low beta, low impetus stocks. Number 1, Sun Pharma, number 2, SRF, number 3, Pagrid, number 4, Colgate, and number 5, LTTS. Now friends, this high beta and low beta hierarchy can change from hour to hour, day to day. So do keep sharp and stay alert. Connect with me on social media. My contact coordinates come at the end of this newsletter, video newsletter. So trade light in the coming week. I expect volatility to rise. And if you like this video, do connect with me and subscribe to my YouTube channel. Click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad, or ugly, I'd love to hear from you in the comment section. Also, in the contact coordinates that come up, do send me an email if you want to be on our free WhatsApp broadcast list. No tips, no stock recommendations, but a lot of market helpful gyan coming your way. Also, below the video in the description segment are hyperlinks to my Equity Master playlist, wherein I put up a couple of video ideas every week. Do subscribe to this channel also, and also take the opportunity of availing of a free trading guide from Equity Master, the hyperlink to which is also enclosed in the description below this video. I thank you for your patience, for being with me in my video. Till we meet again next week, do take very good care of your trades, health, and investments. Vijay Bhambwani signing off for now. My contact coordinates coming up next. Take care. Bye-bye.